What is the stochastic technical indicator? How effective is it when used as part of a trading strategy? I have experimented with hundreds of different technical indicators before learning which ones work the best. And I'm going to share my findings with you. Welcome to this episode of Ahead of the Trade. The goal of this channel is not to sell you any paid course, it is to help you develop an extensive understanding of many different technical indicators and to show you exactly how to apply them in real trading strategies to help you discover your trading edge. Today we are going to be exploring the stochastic technical indicator. We'll discuss what it is and how it works. We'll explain the best settings for you to use for your own style of trading. We'll talk about the most effective ways to use the stochastic within a trading strategy. And finally, we'll discuss some of the most common mistakes beginner traders make when using the stochastic and how they can be avoided. The stochastic indicator was first introduced in the late 1950s by the securities trader and technical analyst, George Lane. Since its inception, the stochastic indicator has become one of the core technical indicators widely used by traders of all different markets around the globe. The original purpose of this indicator was to measure the momentum of price. As the founder George Lane has said, stochastic measures the momentum of price. Visualize a rocket going up in the air. Before it can turn down, it must slow down first. Momentum always changes direction before price. The stochastic is an oscillating technical indicator, range-bound between values of 0 to 100. It is available on all reputable technical analysis charting platforms. This is what it looks like on a chart. This line is called the %K, also known as the fast line. This line is called the %D, referred to as the slow line. What it conveys is whether price is closing closer to the highs or the lows of its recent range over a set period of time. In traditional use, a reading of 80 or higher is considered overbought and a reading of 20 or lower is considered oversold. However, as we will explain in this video, there is far more to the stochastic than simply generating overbought and oversold signals. Before we get into how the stochastic indicator works and the best ways to use it, we must first establish an understanding of price trends, waves, and cycles. Here is an example of price trending higher on a chart. An uptrend is most simply defined as a series of higher highs and higher lows. Within any trend, we can identify multiple different waves of price movement. Each wave is made up of two cycles, a cycle up and a cycle down. How many cycles can you see on this chart? I can count 4 cycles. The cycle ups are highlighted in green and the cycle downs are highlighted in red. The way we use the stochastic is to determine when these cycles begin and end to better time our entries and exits whilst trading. Ideally, we want to buy at the beginning of a cycle up and sell at the beginning of the cycle down, as you can see marked on the chart. We will come back to this concept shortly. Now that we understand the basics of trends and cycles, let's explore how the stochastic works. The way that the stochastic indicator generates a value is by use of this formula. %K equals the current value of the stochastic indicator, the faster line, where C equals the most recent closing price. L equals the lowest price traded during the look-back period. H equals the highest price traded during the same look-back period. T equals time, the number of candles we are looking back upon, called the look-back period. %D equals simple moving average period of the %K, the slower line. It is important to understand that the shorter the look-back period chosen for the stochastic, the more responsive it will become. The trade-off for this additional responsiveness is that it will display far more noise. Noise means information that may not necessarily be useful or relevant and will have a very jagged visual appearance. In comparison, a longer look-back period, which will produce a slower moving stochastic, will appear much smoother and show far less noise. The trade-off for this is that some of the trading opportunities may not be shown on the stochastic because of how slow it is to respond. There are many different settings that can be used for the stochastic. Because cycles on lower time frames take less time to complete than they do on higher time frames, we need to use the appropriate settings for our stochastic based on which time frame we intend to do most of our trading. I recommend 533 for %K, %D and smoothing respectively for traders who prefer to trade on lower time frames such as 1-minute or 5-minute charts. For traders who trade on a higher time frame, such as the 15-minute or 1-hour charts, 1433 is very effective. For swing trading, on time frames of daily or greater, I also recommend 533. Lower %K values will give earlier signals with more noise, which can be a massive advantage when used correctly for trading in the highly competitive intraday markets. Higher %K values offer far slower and smoother signals that reflect larger changes in momentum. These settings recommendations are what I have found to be most effective after hundreds of hours of backtesting and trading with the stochastic indicator. However, I encourage you to experiment with different settings in your own trading platform to see how they affect the appearance and signals generated by the indicator. You must decide for yourself which variables you will use for your own style of trading. This will be determined by how much noise you're willing to accept or tolerate and how quickly you require signals. Whatever you choose, the more experience you gain with the stochastic indicator and the particular settings you decide on, the better you will become at recognizing reliable signals and being able to quickly differentiate them from the surrounding noise. A signal from the stochastic that it may be a good opportunity to buy will look like this. Both the %K, fast line, and %D, slow line, are in oversold territory, below 20. Our buy signal is given when the fast line crosses above the slow line and aims higher on the oscillator. Like it does here. This signals a potential reversal in momentum and is a spot where we may wish to enter a trade. A potential sell signal, as displayed on the stochastic, looks like this. Both the fast and slow lines are above 80, indicating overbought conditions. The fast line crossing below the slow line is our signal to sell. This means that the cycle up has likely come to an end and the next cycle down may be beginning. To use the stochastic indicator effectively, we must be sure not to enter a trade based only on its given signals. We must gather additional information before we can decide to act upon a signal generated by the stochastic. The first thing we must do is determine whether price is currently trending up or trending down. If price is currently trending up, as it is in this example, we only want to buy on strong oversold signals. This ensures that we are trading with the trend, never against it. As we have explained in previous strategy videos, an excellent indicator for determining the current trend of price is the 200-period exponential moving average, 200 EMA. If the 200 EMA is pointing up, we take signals to buy, whereas if the 200 EMA is pointing down, we take signals to sell. Secondly, as well as trading with the trend, we also need to see confirmation of our stochastic signals. The way I personally confirm signals given by the stochastic is to look for confluence with other technical indicators, such as the Bollinger Bands, featured in a previous video. I also want to see price action developing that supports what the stochastic is conveying. This could include a doji candle, an engulfing pattern, a hammer candle, or any other candlestick pattern that is indicative of an impending reversal of price. We will explore price action candlestick patterns, such as these, in more detail in a future video. It is also important to note that momentum reversals often take place at key price levels that have previously acted as support or resistance. Stochastic signals around support and resistance levels are generally more reliable. Once I identify confluence between the current trend, the stochastic indicator signals, other technical indicators, key price levels and price action, I am able to enter my trades with a far higher level of confidence that the price is most likely to move in my favor and I will be able to make a nice profit. For my own personal trading style, I require all of these conditions to be met before I take a trade. This results in my win rate being quite high compared to many other traders because I only take trades based on the best quality signals with multiple sources of confirmation. Here is an example of a trade that I have taken recently. This green arrow is my entry and this red arrow is my exit. Notice that I have entered after the stochastic has given me an entry signal when price is at a support level, suggesting that price may move higher from here. When taking a trade based on a stochastic indicator signal, it is best practice to position your stop loss below the lowest point of the cycle down, known as the cycle low, when buying to enter your position. Or above the highest point of the cycle up, known as the cycle high, when selling to enter. This will make sure that if the signal turns out to only be noise and not in fact a valid trade entry signal, you will stop out quickly for a small loss and will be ready and able to attempt another entry at the next signal instead. The three most common mistakes made by beginner traders using the stochastic are: 1. Not having their stochastic indicator set to the correct values. 2. Blindly following stochastic signals as trading opportunities without additional confirmation. And 3. Trading based on the noise as opposed to valid signals. All of these mistakes can be identified and rectified by practicing trading the stochastic in a simulator account. This will ensure that you feel comfortable with your settings and confident in your ability to identify genuine trading opportunities using the stochastic before attempting to use it in a live trading scenario. I'm sure you now have a far better understanding of price trends, waves, cycles, and how to use the stochastic indicator to accurately time your entries and exits when trading. If you have any questions about the stochastic indicator or technical analysis, feel free to join our community Discord. If you found this video to be helpful, consider giving it a thumbs up and subscribing. Let us know in the comments what strategy or indicator you want us to explore next. See you next time on Ahead of the Trade.